Good morning, everyone, and welcome to
Medha,
today's.
1 second.
Yeah,
Medha, you can start now. Sorry.
a very good morning to all the viewers, and thank you all for joining in today's NFO briefing session that we have scheduled for our new offering, that is Aditya Birla Sunlife Multi-Asset Allocation Fund. Multi-asset allocation fund. Multi-asset allocation fund is actually an equity-oriented hybrid product. It is a product which is typically designed to address the asset allocation need of individuals. So, what is multi-asset allocation fund? Multi-asset allocation fund is typically a fund that invests in three or more asset classes at any point in time. In the case of the fund that we are discussing today, it's an equity oriented fund, which means that the majority of investments would be made in equity. And marginally, the remaining investments are going to be made into other asset classes, which is fixed income and commodities. However, before I start talking about the merits of this product, let me also mention to you that barring equity, fixed income, and commodities, the fund also has a provision to invest in REIT in REITs as well as international equity. So net, whatever be the asset classes that you may wish to invest in or participate in, the fund has a provision to invest in all of them. Now, various surveys, research, white papers over a period of time have suggested that asset allocation is the key determinant of portfolio returns. Uh, One may, of course, the way to wealth creation that we've known for the longest periods of time is equity, staying invested in equity for a long period of time of 10, 15, 20, 30 years is the path to wealth creation, definitely. However, as important as it is to participate in equity, it is equally important to have participation in the other asset classes, right? And why is that so? There are a couple of reasons for it. The first and the foremost reason is that different asset classes perform in different periods of time, and there is no one single asset class. More importantly, equity as an asset class which can consistently keep doing well. In fact, there are multiple periods in which equity, which is relatively a volatile asset class, has delivered sharp drawdowns, which means sharp negative performances. And when a portfolio is built along with equity, there are alternate asset classes like fixed income and commodities. They simply act as a shield or a cushion for to sort of balance the underperformance of equity in intermittent time periods, and that is the underlying logic also of a multi-asset allocation fund, where of course the predominant investment is happening in equity, which is at least 65% of the investments is happening in equity. The other very important reason why a multi-asset allocation fund is important, because just like just like there are seasons, there are phases in the economy too, right? There are market cycles too, and various asset classes, the different asset classes have different performance cycles across economic cycles and market cycles. It is typically seen that in periods of high economic growth, in periods of expanding economy, when in the common parlance that we use, we call it the bullish cycle that market sees. Equity as an asset class becomes extremely rewarding. However, in periods where interest rate is easing, which means it's on a downward trajectory, macroeconomic environment is stable, fixed income as an asset class becomes extremely rewarding. On the other side, amidst periods where there are geopolitical conflicts, high inflation, periods of high volatility, uncertainty, gold as an asset class, or for that matter, precious metals tend to do well too. And hence, it makes just a lot of sense to, stay participated in all of these asset classes over a period of time. We may have, time and again been investing in these asset classes alternatively based on, our judgment of what time is suitable or not. But, the key to generate better risk-adjusted returns, by risk-adjusted returns, I mean one can generate good returns with lower level of exposure to equity and with lower volatility too that the equity markets usually bring along with it, only if there is a disciplined allocation across asset classes. And why is this disciplined allocation very important? That is because the performance of these asset classes shares a very weak correlation. They are not synchronized with each other. Typically, in periods when equity tends to do well, fixed income, maybe commodities, may give rather moderate returns. But definitely, in periods where equity underperforms, or in periods where equity market has given sharp negative returns, it is often seen that fixed income and gold can come to the rescue of the investors and in turn is able to sort of balance out the overall portfolio returns. We've seen it in multiple phases of economic cycle. That is in periods when Lehman crisis happened in 2008 or in periods of 2013, etc., when fixed income gold typically gave very good return. So net, the reasons, the key reasons why one should consider a multi-asset allocation product is because asset allocation is a key determinant of portfolio returns. We have actually done a back testing. We've created a model at our end for the purpose of this product where we tested a model with 65% equity, 20% allocation to fixed income, and 15% allocation to gold over the longest periods of time. And let me share with you that the results from this model were very, very heartening. What we figured out is if one were to stay invested in this proportion, of 65% equity, 20% fixed income, and 15% in gold, say over a period of 15 years, 10 years, 20 years, the results show that this portfolio is able to participate in, about 80% of the equity returns. So what I mean is if Nifty 50 has delivered about 17% CAGR over 15-year and above period, then this portfolio has been able to generate 15% CAGR, which means 80% of participation is what this portfolio is able to make. On the other hand, this participation being aside, the volatility participation means the standard deviation of this portfolio is at about 60% of what the equity market volatility is. Net, what we're trying to say is one is able to capitalize on 80% of the equity market returns with a 65% allocation to equity only across time periods with a volatility which is 40% less than the market volatility. And that is seen across time periods like 15 years, 10 years, 7 years, 5 years, etc. And hence it shows that is the true essence or true testimony to the fact that how disciplined allocation across these asset classes makes a lot of sense to generate superior risk-adjusted returns. Before I just, before I close the session and, I start taking your questions on this topic, let me just share with you once again how we plan to, make investments in this fund. First of all, like I just mentioned to you, it will be a 65 to 70% allocation in equity, about 15 to 20% allocation in fixed income, and similar about 10 to 15% allocation in gold on a steady state basis. The equity portfolio will largely be a large cap oriented portfolio. The fixed income portfolio will largely be, an accrual portfolio, which means it will be investing in high quality debt instruments and bonds, AAA, AA plus rated, with a short maturity. And of course, there will be, allocations to precious metals, especially gold and also silver. So at this moment, let me just take a pause and start looking at the questions. So the first question that I see is, sorry, does the fund invest only in gold or in other commodities too? So the fund has the leeway to invest in gold as well as silver, gold ETFs and silver ETFs. Those are the commodities in which the fund would typically be looking at. At this juncture, also, till the question starts streaming in, let me just take a couple of minutes to share with you, the brief rationale around why, invest in a combination of equity, fixed income, and gold at this point in time in terms of how is the market enabling. So, of course, equity, we all know that from a 3-year, 5-year perspective, it is a structural story. There are, especially in India, where, India has the highest growth projections, one of the fastest growing economy in the world, where the macros are very stable, pretty strong. The fiscal prudence has been tested time and again. So, there are a lot of factors which are enabling for India. In terms of valuations, all the equity market valuations are on the higher side, yet from earnings standpoint, there are various sectors, in fact, multiple sectors as compared to the pre-COVID era, which are, posting good earnings growth potential. Sectors like banking, auto, consumer, even, oil and gas too. So there are various, industrial goods. There are various such sectors which look very promising at this point in time. The fund would be looking at also, allocating to multiple sectors. Apart from that, in the backdrop of the current global environment, what we have seen is that interest rates have risen significantly, and while they have risen significantly, but the pace of rate hikes across the world has slowed down and is expected to slow down further. Inflation seems to have peaked out. Global growth seems to be going, is expected to slow down. Within all of this, what has happened is fixed income investments have started looking really, really lucrative and rewarding. Interest rates being at the levels that they are, the absolute yields are, very interesting. And hence, it makes a huge case, for participation in fixed income alongside equity. On the other side, gold as an asset class as compared to last year, it has certain key enablers in place for it to, sort of do well in this year. Because gold typically tends to perform well in periods of high inflation, in periods of geopolitical conflicts, in periods of high volatility, in periods where dollar has a depreciating bias. In typically these periods, gold tends to do well. And volatility has not gone out of the world. It is expected to continue over the period of this year too. And hence we expect that gold should also post decent returns this year. And hence a combination of investment in these asset classes, and especially in the backdrop of the fact that asset allocation is the key theme for this year, not just in India, but across the globe, because the returns from equity are expected to be rather tepid or moderate this year. And hence it makes a lot of sense to, stay participated across asset classes, than to build incremental allocation only in one. Okay, so let me just go for the questions that are there. The next question that I see is why not choose multi-cap fund rather than multi-asset fund? Oh, multi-cap fund is an equity-only fund, firstly, which would invest across market caps. In terms of the portfolio positioning on the equity side, I would say that multi-cap is more aggressive in terms of the equity portfolio positioning, because at any point in time it would have at least 50% allocation to mid and small caps, 50 to 60 also at any point in time, which of course takes up the risk quotient aggressiveness of the portfolio to a significant extent. As compared to that, this fund would have just about 25 to 35% allocation into mid and small caps. Rather, the predominant allocation is going to be large cap stocks. So that should bring relatively more stability and lower down the risk profile of this fund. What is an ideal investment method for this fund? SIP or lump sum? Oh, this fund, it's like an evergreen fund. SIP, great. STP, really good. Lump sum, of course, during these market, although it really doesn't matter if you are looking at investing for 3 to 5 years sort of a period, but I'm sorry. I would strongly suggest that in periods like the current one, systematic investing should be the chosen route to participate in any equity-oriented or equity-oriented hybrid product or equity-only product or even multi-asset allocation product. Okay. What is the minimum investment amount in the fund? It's 500 rupees. Which sector is going to grow fast next year? There are multiple sectors which we are, pretty convinced on, bullish on. Private banks is one of them. We are very bullish on the theme of manufacturing in India. We are bullish on consumption within that. Discretionary, low ticket discretionary consumption is a theme. The earnings, the number of auto as a sector is also very good. There are also certain other sectors like, industrials, real estate, in which, we expect good traction. So there are actually multiple sectors, and it's difficult to, sort of zero down on one or two sectors, which is expected to grow very fast. And let me at this point also mention that it's more than next year. For sector stories, we typically look at least 2 to 3 years period. Of course, 1 year, there are, sectors which are expected to, come up, like I spoke of private banks. We see that there is, as compared to broader market performance, banking index per se or banking stocks per se have not yet caught up, and hence we see, potential for that sector to do really good over the next 1 year, 1 to 2 years at least. The next question is why gold tends to perform in inflationary periods when there are geographical tensions. So it's typically, gold is a safe haven asset, right? In most periods, and it's not just maybe a recent phenomenon. I think for time immemorial, it has been used, to sort of invest in, if I can use the word, or store gold in periods of uncertainty. Whenever there has been, external instability for countries, there are even currently, as we look at the geopolitical scenario, there is one line of discussion, one school of thought, which is saying that countries across the world are increasing their, reserves in gold. So they have to keep forex reserves. Usually it's kept in one's own currency, in the US dollar, and also in currencies of other economies, and also in gold. In that proportion, the quantum of gold has been increasing across economies because, there is definitely change of world order, which seems to be, in place. There is a sort of struggle to sort of find supremacy. There are countries which are struggling with each other. So amidst all of this uncertainty, gold definitely fits in as a sort of a safe haven asset. Okay. So there's a question: what is your thought about consumption? Of course, consumption is a theme. India is a consumption story. Why India is a consumption story? The demographic dividend, by which I mean the population size of India, the growing per capita income of India, and from the lows that we are at, is typically an indicator of how consumption patterns, how consumption spending is expected to constantly increase in India. Apart from that, there are trends like urbanization, nuclearization, brand consciousness, awareness and aspirations, increasing awareness and aspirations. All of this put together, what does this tell us? In very simple terms, if the income of an individual increases, what does he do? He, apart from spending on staple items like food, that we eat, one would want to change the lifestyle. Basically, you want to wear better, you want to wear better clothes, you want to have more number of footwear, you want to travel around, for which maybe you need good travel equipments. COVID has taught us that you need to take care of your health. So, spending on healthcare. COVID, it has also taught us wellness is important, spending on wellness needs. We also know now, more importantly than ever, that we need to stay fit. Our health is important. So to stay fit, you need to sort of invest into various such avenues, spend on various such avenues, basically. So what all here are we talking about? We spoke of apparels, we spoke of footwear, we spoke of, say, travel sort of things. Maybe, what do you say? You need something like maybe a VIP industries comes into picture. We spoke about footwear companies. If of course, if we have more to spend, we may be wanting to dine out. So, QSR companies, that makes so much sense. We may, drinking, home partying outside is becoming a bigger trend. So alcohol consumption, alcohol companies come into the picture. There is, a shift from unorganized to organized as a theme, structural theme that is happening. People are becoming more brand conscious. People who are working want to wear branded clothes, want to carry a certain style statement with them. All of this put together, net ties around the consumption story, the structural consumption story that is building in India. Okay. Let me take the next question. Since it is multi-asset, in the past, how many times has it outperformed Nifty over a period of 3 years? Just allow me a moment. I will share with you the exact data on this. Just compared to Nifty, where, the model that I spoke about while I was addressing this session, where we backtested a model of 65% equity, 20% fixed income, and 15% gold. We did that model's testing against equity markets performance, which is Nifty's performance. And what did we see is over a period of 15 years, this multi-asset portfolio, our model portfolio, generated about 10.5% returns as compared to equity Nifty 50, which generated 9.5% returns. On a 10-year basis, this portfolio gave 11% versus equity, which gave 13%. On a 5 years basis, this portfolio gave 12.5% as compared to Nifty, which gave 14.3%. So that is the sort of, and 3 years, okay, 3 years was the question. Our model portfolio gave 14.5% returns as compared to Nifty in 3 years period, which has given 17% returns. So that is a sort of, difference. The next question is, what is the difference between multi-index fund and multi-asset fund? Okay, so multi-index fund that we have is basically a passive fund which is going to participate. Similarly, the logic, the underlying theme is asset allocation. The underlying theme is also similar to participate across asset classes like equity, fixed income, and commodities. The mode is different. That's going to participate in that by investing in various indices, like the index funds do. And this fund is directly going to be investing in stocks. So that is the major difference. Okay, so there was one other question. Will this fund help beat market volatility? Of course, I think that's one of the key things that I mentioned to you, that over longer periods of time, like 5 years, 7 years, 10 years, 15 years, the performance of the model portfolio for this fund that we have tested shows that this fund is able to participate in 80% of equity market returns on an average, with about 60% participation in market volatility. Let me also at this point share another data point with you. So in terms of drawdowns that we see, by drawdown, what I mean that when the market falls, the sharpness of the market falling down. So over a period of say last 15, 17 years, equity market average drawdown has been about 9%. Gold's average drawdown has been about 10%. And this portfolio, model portfolio's drawdown has been about minus 4%, which means that it is given 60% lesser drawdown as compared to equity or gold as an asset class. So definitely all of this puts in, brings in together the lower volatility aspect of this fund, and hence I keep saying that it is has a potential to generate better risk adjusted return, adjusted for the risk and volatility. Okay, then let me just, possibly, I see there are no other questions here. So let me just, sort of conclude this session by summing up, the key points for you. So the key reason why, like what I told you, a multi-asset allocation fund makes a lot of sense is because asset classes act as a hedge against each other due to their weak or negative correlation with each other, which means that they don't, technically all of them don't perform well in the same market phase, in the same economic phase. Rather, they alternate. No one asset class consistently, tops the chart, is a winner, year on year or across market cycles. And hence, it's important to stay invested in a disciplined way across asset classes. The other important thing is diversification across asset classes helps reduce risk and hence generate, better, more optimum portfolio returns with lower risk. Okay, I think there's one last question that is there, which goes as, are there any views on the IT sector? Of course, so on a structural basis, on a long-term basis, we are positive on IT as a sector. In fact, selectively, on a bottom-up basis, on a stock-by-stock basis, we are invested in, we are, sort of reinvesting even in funds where we were underweight in IT as a sector, and which helped the fund also in the period, last year's period, when the sector corrected massively. But on a near-term basis, in the background of global growth slowdown, the prospects of IT as a sector, on a broader basis, is sort of a little cautious, because global growth slowdown means that the spending, in IT as a sector is also expected to sort of moderate from where it is. However, in terms of valuations, it looks, some of the companies look quite, what should I say, encouraging, and hence we are selectively looking at participating. Okay, I think that is all. I think these are the questions that are there. So thank you very much, everyone, for spending your valuable time this morning in this session. And I happy investing to all of you all. I think this is a great investment opportunity, which is suitable for any and every investor who's looking at staying invested in an equity oriented fund, and and especially for first time investors or for new investors, it gives an excellent opportunity to participate across asset classes through one single fund, without having the hassle of sort of choosing different products for the different to participate in different asset classes, or to sort of looking at the conducive market scenario to participate in different products from different asset classes. You don't need to take that hassle. And most importantly, it becomes tax efficient too, because the rebalancing that would happen from equity to debt to commodities, vice versa, it happens within the fund, where an investor simply is eligible for equity taxation, and hence from that standpoint also it makes a lot of sense. So with that, I would conclude the session. Thank you very much for joining me today.